In this video, we are going to have a look at the different types of short-term finance and short-term investments. So there are many types of short-term financing, and these include trade payables, factoring, as well as invoice discounting of our trade receivables, bank overdrafts and bank loans, as well as financing exports. So let's first begin with trade payables. So trade payables allow us to use credit terms which are offered by our suppliers so that we can pay our invoices at a later date. This can be advantageous to us as a business because ultimately it allows us to improve our own cash flow because we can delay the cash actually going out of the business. By having this credit, it allows entities to fund inventory of material through suppliers. Entities should aim to leave payment as late as they possibly can without damaging any relationships. This would bring about the most benefit. There will sometimes be a cash discount offered for early payment, so prompt payment discounts, I'm sure, is a phrase that you are familiar with. But if this is offered, an entity has to weigh up the options of actually taking advantage of that, because sometimes it may be best just to not utilise that if you're getting a better interest rate in your bank with that cash there, as opposed to how much you would actually be saving if you were to pay that invoice early. Paying suppliers late then has its benefits, but it also has its drawbacks. So obviously, like I've just said in the previous slide there, a big benefit is it alleviates any cash flow issues. The cash is staying in your bank. And whilst cash remains in the entity's account, it of course does earn interest. So you're already getting a return on it. But there are some problems with doing this. If you continue to pay your suppliers late, you could obtain a poor credit rating. They may even choose to stop supplying you. They could put a stop to any settlement discounts that they have agreed with you previously. And even worse, if things got very serious, they could face legal action, as well as telling you that they are no longer willing to work with you or supply to you because of it. If they didn't want to go to that extent, they may well just increase their selling prices to compensate for the fact that you have not paid your previous invoices on time. The next one then is factoring and invoice discounting of receivables. So what is factoring then? So this is essentially where debts of an entity are sold on to a factoring company. The factoring company will usually be owned by a bank. A factor may accept to collect debt on behalf of an entity for a fee in return. You could go to a factor and they can refuse to do it for you. A factor is quite good because they are usually better at enforcing credit terms, which obviously is going to reduce your level of receivables. So there are three different services that a factor would offer. So the first is debt collection. So essentially that is just outsourcing your credit control function. The second is a financing. So a financing element arrangements could be dealt with by the factor, and those funds may be advanced to the company before the debt collection even occurs. And the third could be to do with credit insurance. So this is when the factor dictates who the entity can actually offer credit terms to, as they take the lead in irrecoverable debt. And this is what we know as without recourse. Invoice discounting then is also a factor service. This is where a selection of invoices is going to be used to measure the amount of funds that an entity is able to borrow. It is a very temporary source of finance which is repayable once the debt has been cleared. This is a very confidential service. A customer would never know that an entity has chose to use invoice discounting. So a good example of this is when a new business is actually looking to borrow money because there's not enough financial records or enough documents for a lender to actually have a look and make sure that they are credit worthy. So credit rating is going to be poor. Financial institutions then. So entity with core focus of dealing with financial and monetary transactions. All transactions will vary and are not limited to, but can include currency exchange, investments, deposits, etc. So financial institution will encompass many business operations within the financial sector. So banks, broker firms, trust companies, insurance companies, just to name a few, are all examples of this. So short-term finance are mainly going to be provided by banks, whilst the others are more suitable for long-term finance. Short-term borrowing then. So this includes bank overdrafts, bank loans, which I'm sure you are both familiar with those terms. So bank overdrafts then. It's short-term, it's flexible, and it's linked to company bank accounts that are overdrawn. An overdraft will prove to be a very important source for an entity because of how flexible you can be with it. Obviously, that is a big advantage of it, but there are disadvantages to this. If you use your bank overdraft, it is repayable on demand. Finance costs are going to be variable, so you're not going to know the interest rate at which you are going to have to pay on the amount that you borrow until that actually happens. Bank loans. So this is a contractual agreement and it is always going to contain a specified sum, a loan for a fixed period, and an agreed rate of interest. It is less flexible in overdrafts and it can be very expensive, but there is a much greater level of security with a loan. Moving on to financing exports then. These include documentary credits, bills of exchange, export factoring, and forfeiting. So documentary credits then, also known as irrecoverable letters of credit. So a letter of credit is an undertaking given by its issuer that payment is guaranteed for the exporter. The exporter must be compliant with specific requirements within a given time frame. And it is a document that is issued on behalf of their customer by the bank. The document will authorize a person to withdraw money to a specified amount from the branches once a condition has been met. A bill of exchange then. So this is used primarily in international trade, and it is where one party must pay a fixed sum of money to another party on demand. After a bill of exchange has been signed by a customer, they have acknowledged that that debt exists. They must then commit to pay it. So the sight bill is payable immediately, and the time bill will be payable at a predetermined future date. You may see the terms drawer and payee. They are often the same person. So the drawer is the supplier, and the payee could also be the supplier as well. So what are the characteristics then for a bill of exchange? So a period of credit will be given prior to having to pay a term bill to the drawee. The payment can be obtained earlier than the bill's maturity date if the bill is discounted, and this could only be done by the drawer or the payee. You may also hear this as being referred to as acceptance credit. Export factoring then is what we're moving on to now. So it's like ordinary factoring. It's agreed to the factor the client export trade receivables. So services for export factoring then include providing factor finance, collecting payments, and administering receivable balances. Sellers' overseas receivables will be bought for a lump sum, which will often be lower than the outstanding debt amount owed. An export factor's expertise can be very helpful when it comes to collecting overseas debts, simply because they've got that level of speciality there. Forfeiting. So this is the same as export factoring, except the seller is going to receive 100% of the receivable as a lump sum. So the exporter would draw up a bill of exchange from an importer, and the bill would then be purchased by a forfeiting company. It will usually be a bank. The total amount owed would be given to the exporter whilst the forfeiter chased the debt. The importer would then settle direct to the forfeiter. In this instance, there would be no risk to the exporter because ultimately they have already obtained payment in full for all the goods that have been previously supplied. So what are the key features of forfeiting then? Well, the exporter receives payment immediately. Medium-term finance is able to be obtained in order to cover any purchase costs for the importer. The credit risk will be accepted by the forfeiting bank, but this risk can be reduced again if a bill of exchange is drawn up. So that's the short-term finance. Let's move on to short-term investments. So how do we maximize profit with cash surpluses? So we could invest in an interest-bearing bank account, or we could use some negotiable instruments. Perhaps we may turn to short-dated investments or other short-term investments. So what should be considered when an entity makes any investment decision? Maturity. So is there a specific time frame? How much interest is going to be received within that time frame? And if cash is needed before the maturity date, will it have to be withdrawn? And also, can it be withdrawn? Return. So what is the interest yield on the investment? If the investment is redeemable, the capital repayment will also be part of the return. How much risk is involved? Is the investment likely to fall in value? And is there going to be any doubt about an eventual interest payment? What does the future of the business look like? Is it looking positive, or is it perhaps not looking so positive? Liquidity. How easy is it to cash an investment in? Short-term investments are always going to be less liquid as opposed to cash in the bank. Diversification. So investors should expand their portfolios and not focus solely on one thing. Different investments are key, but they are less essential for short-term investments. However, by diversifying, you may well get a better return. Interest-bearing accounts then. So we have deposit accounts and we have money market deposits. So deposit accounts then are exactly the same as instant access in some cases, which means that investors can withdraw whenever they want to, but the interest rates will be lower. There will be a suffering of lost interest. An investor may be unable to withdraw the funds from there without giving a minimum notice period. Contrary, money market deposits are amounts of money deposited through a bank in money markets. The interest yields in the interbank market are often reasonably attractive, but the money cannot be withdrawn until that deposit matures. So it should not be invested in longer than the investors would expect a cash surplus for. So in order to calculate interest earned, there is a formula. So we would do our deposited amount multiplied by our annual interest rate, multiplied by our number of days of interest earned, divided by our annual day count. What are negotiable instruments then? So financial instruments can be obtained as investments. Title passes when the instrument is handed from person to person, and ownership does not have to be recorded in the register of owners. These can only be sold, however, from one entity to another. So some examples of these are banknotes, bearer bonds, treasury bills, bills of exchange, deposit certificates, and they're just to name a few. There is more. Short-dated government bonds then. What do we mean by this? So this is where temporary surplus cash can be invested. This will result in interest being received on the due payment date. With short-dated government bonds, they can be sold at any time, which could lead to a liquidated investment. And if the bonds are short-dated, the bonds can be held to mature and then can be redeemed. Market value bonds can decrease at any time, though, in value, but they can also increase. So, of course, there is an element of risk there. Other short-term investments, just to give you a picture of what they could include, would be corporate bonds, commercial paper. We aren't going to go into those in detail, but there are other options that an entity may look into.